Payment stands as one of the fundamental pillars of economic activity. When making a purchase, it is necessary to possess something desirable to the seller in return. Bartering serves as one option, but it faces inherent challenges due to the likelihood of possessing an item desired by the counterparty at any given moment. Early forms of currency such as cowrie shells, beads, and metal coins offered a solution by consistently holding value for transaction settlements. However, they presented their own complications, including counterfeiting, delays, and the potential lack of immediate availability. Illiquidity. The introduction of credit and trade, documented as early as 5,000 years ago in Mesopotamia, revolutionized the landscape. It provided instant liquidity, fueling commerce, but necessitated trust and verification, ushering in a fresh set of complexities. Throughout the ages, physical objects, including cash, have been the primary means by which humans conducted transactions. Initially, banks were established with the purpose of safeguarding commodities like grain, rather than being directly involved in consumer payments. Subsequently, the introduction of checks became linked to bank accounts. However, it was the advent of the first credit cards, pioneered by Diners Club in 1950, and the implementation of magnetic stripe cards, notably by American Express in 1971, that initiated a broader shift away from traditional forms of payment such as paper money and checks. Nonetheless, these advancements predominantly remained confined to developed economies and catered to affluent customers of banks, which continued to serve as the central nodes of financial operations. Presently, a new wave of digitization propelled by smartphones and the internet is revolutionizing payment systems once again. This transformation enables near instantaneous remote payments, significantly minimizing the obstacles involved in the movement of money. Consequently, it facilitates long-distance trade while leaving behind a transparent and traceable transaction trail. Moreover, digitized payment methods hold the potential to serve as a foundation for the provision of expanded financial services, which proves especially crucial in less economically developed countries with limited financial infrastructures. The advent of digital payment platforms brings forth the promise of ushering in new dominant players within the immensely profitable global payment system, which raked in a staggering $2.1 trillion in revenues in 2021. It suggests a departure from cumbersome banks, expensive credit cards, and the unseemliness of physical cash. Instead, we witness the rise of captivating crypto protocols, seamless fintech wallets, and even digital central bank currencies. Admittedly, some of the excitement surrounding this transformation may have been excessive. Nevertheless, this exclusive report posits that the very mechanism of monetary transactions is indeed undergoing a colossal mutation. The prevalence of cash-based transactions is dwindling rapidly, experiencing an average decline of 25 percentage points across the world's major markets between 2011 and 2021, with emerging economies witnessing some of the most significant drops. Digitization plays a substantial role in driving this shift away from cash. Across the globe, an array of payment systems is emerging, each presenting its own set of advantages and disadvantages. Interestingly, the driving forces behind this transformation are not solely confined to innovative fintech firms, digital newcomers, or flashy cryptos. In many instances, it is a collaborative effort between state-led initiatives and established banks that is spearheading the rewiring of payment infrastructure. For instance, in India and Brazil, government-sponsored payment platforms have emerged as the dominant non-cash payment methods, successfully integrating hundreds of millions of previously unbanked individuals into the formal financial system. In the Western world, despite facing competition from Fintech's disruptors, the traditional bank card model has largely withstood the impact of digitization. Meanwhile, China's closed fintech applications and novel settlement system have the potential to extend their influence throughout Asia, thereby reducing the region's reliance on the US dollar. The evolving landscape of digital finance carries significant implications for the relationship between money and the state. Some governments may leverage digital financial systems to exert greater control over their citizens. As digital payment platforms proliferate, the West may experience a reduction in its financial influence. While frictionless money movement enhances efficiency, it also raises concerns about potential financial instability, as easier access to bank deposits could lead to increased customer withdrawals, as exemplified by the Silicon Valley Bank's failure following a bank run. As with any new technology, digital finance has been subject to both hype and scrutiny. However, modern digital payment platforms are undeniably challenging the established order. While banks traditionally served as the entry point to formal finance, apps utilizing QR codes, fast payment networks, and high-speed internet connections have now become the gateway for many individuals. As users engage in money transfers through these platforms, the data collected can unlock access to additional financial services, such as loans and insurance. An excellent illustration of this transformative trend is China's Alipay, which originated as an escrow service for Alibaba's e-commerce platform. Previously, purchasing video game points necessitated an in-person visit to a brick-and-mortar store. Alipay, drawing inspiration from PayPal's servicing of eBay, revolutionized e-commerce by utilizing smartphones and sheer codes to rapidly scale up operations. Alongside WeChat Pay, it now handles approximately 90% of digital payments in China. Nowadays, cash payments have become increasingly uncommon there. As the world transitioned towards a cashless society and with historically low interest rates making money practically free, a frenzy engulfed the realm of digital finance during the summer of 2020. Numerous new crypto protocols were launched, offering interest rates of 20% or more on crypto deposits with seemingly no risk. The overall market value of the cryptocurrency sphere surged to $3 trillion in 2021. Ant Group, a Chinese payments and lending firm, prepared for a highly anticipated listing with a projected valuation exceeding $300 billion. By the summer of 2021, PayPal's value reached approximately $350 billion, placing it in close proximity to JPMorgan Chase, the world's largest bank, and Visa, the largest card network, valued at $450 billion and $520 billion respectively at the time. However, the frenzy proved to be short-lived. The market turbulence experienced over the past year, triggered by rising interest rates and the repercussions of Russia's invasion of Ukraine, has humbled many digital challengers. The first market to correct itself was China, where the government halted the planned initial public offering of Ant Group in November 2020, providing a forewarning of what lay ahead. The market value of all cryptocurrencies has since declined by nearly 3/5 from its peak in 2021. The Economist estimates that the collective market value of the world's 100 largest public and private fintech firms has been halved since then. Despite these market upheavals, 3 lasting changes have emerged as a result of the surge in digital finance and the advent of new payment platforms. First, the debate in wealthier countries regarding whether crypto or fintech firms would supplant banks and card networks has essentially been settled. Cryptocurrencies have shed their go, getting reputation, and are struggling to prove their practicality. Innovative fintech companies, on the other hand, will undoubtedly continue to grow. Nevertheless, the traditional bank card model has adapted more effectively to digitization than anticipated by those who predicted a revolutionary disruption. In certain instances, the symbiotic relationship between banks and the state has contributed to this stability. In China, the government's intervention to curtail Ant Group's operations allowed banks to maintain their prominence in lending. In the United States, Facebook's attempt to launch its online currency, Libra, was met with resistance as it came too close to the financial sector. As a result, traditional banks retained their position. While Apple Pay and Google Pay are experiencing growth, they currently occupy a niche role in the payments landscape. Cryptocurrency has also undergone a division, with a regulated segment that may eventually become indistinguishable from traditional finance, and a less regulated segment that primarily operates in struggling economies like Argentina. The second significant change is the development of open payment systems in emerging markets. These systems provide an alternative to both the bank card model prevalent in developed countries and the closed fintech behemoths found in China. In fact, it is conceivable that the affluent nations may adopt the best practices from emerging markets through instant bank account transfer systems in Europe, and the introduction of the Federal Reserve's FedNow instant payment service in the United States. The third change involves governments taking measures to decrease their reliance on Western payment networks and the US dollar. These efforts, which have a long-standing history, have been accelerated by the imposition of sanctions on Russia following its invasion of Ukraine. Several countries have established national alternatives to card networks such as Visa and MasterCard. China, for example, is implementing an alternative to the international banking messaging system known as SWIFT. Additionally, certain countries are establishing multilateral payment linkages that enable their citizens to use their preferred domestic payment systems while abroad. For instance, UPI wallets from India can now be utilized in Singapore, While Alipay wallets from China are accepted in locations ranging from Dubai to Washington, D.C., GrabPay from Malaysia can be used across much of Southeast Asia. China is taking the lead in providing an Asiatic payment system with the yuan as its primary currency. As technology progresses and provides more cost-effective alternatives to the US dollar, these systems may pose a challenge to the West's dominance in international finance. Control over payment systems carries significant political power as they are utilized for tax collection and benefit distribution. They generate digital trails that increase the visibility of economic activities to the state, making it harder to evade taxes and engage in organized crime. It comes as no surprise that many governments are cracking down on cryptocurrencies, which initially promised unrestricted access to payment systems. Recently, the United States filed charges against Binance, the world's largest cryptocurrency exchange, for evading American regulations. China is also attempting to ban cryptocurrencies, and India has imposed restrictions on their usage. This report will delve into the contrasting payment models, comparing the bank card networks prevalent in developed countries with the fast payment systems found in emerging markets and the closed fintech systems in China. It will explore the potential role of cryptocurrencies and central bank digital currencies. Furthermore, it will examine how certain governments may leverage digital finance to reduce their dependence on the Western financial system. A logical starting point for our exploration is the emerging world, where much of the most exciting action is currently taking place.